this next panel is on a very important subject, which drives everything else, right? I mean, if we're getting good exits, we're getting good financings, then everything else at the earlier stage happens better and trickles down. And what a year it's been for exits. One of the reasons we invited somebody from a big time bulge bracket bank here is because of the tremendous number of SPACs and other exits that have been happening. And obviously there's a lot of money flowing into this sector as well, especially the last half of last year. So with that sort of general introduction, let me turn this over to our moderator, Andrew Harper of Sidley, the law firm sponsor of our event today, to introduce the panel and the subject. Andrew?
Thanks, Howard. Pleasure to be here and appreciate the introduction. Just to give you a little background about myself, I'm a partner in Sidley's emerging capital and emerging company and venture capital group, and I represent startups at all stages of their life cycle, from inception through exit, IPO, and everything in between. I see a lot of financings. It's what I do with most of my time. And I also represent investors, both financial investors and corporate venture funds investing in these types of startups. I represent all sorts of companies across industries, but tend to specialize in auto and mobility companies, working with clients, lots of clients on the company side, and then representing investors, including BMW and others. So with that, I think I'll just touch on the topic that we're going to discuss here today. As I think everybody knows, the auto and mobility space has historically faced some fundraising challenges due to things like long development cycles, manufacturing is capital intensive, an unfriendly regulatory environment, and so forth. And what we've seen is over the last 12 to 18 months especially has really been an uptick, and where hardware and auto has been hard, it seems to be getting easier. And we're seeing more comfort from more market participants investing in this space and getting into the market. We're seeing a huge flood of capital into autonomous driving, electronic vehicles, supply chain, lidar, batteries, ride hailing, you name it, more so than ever before. So we're going to talk about why that might be, what's driving that, what the current state is, and where we think it might be headed. And we've pulled together a great panel here of people with different perspectives. We've got Tony Cannestra, who I'll let introduce themselves, but just to give you a brief introduction, Tony Cannestra from Denso, Chris Stallman from Fontanalis, and Jason Wortendyke from Credit Suisse. So I'll turn it over to the other panelists to introduce themselves.
Sure, I'm happy to go first, Andrew. And thank you, Howard and Nick, for inviting me to participate here too today. I am a partner with Fontanalis Partners. We are a venture capital firm that is based in both Detroit and Boston. I happen to call Detroit home, or as is home these days, working from Plymouth, Michigan, outside of the city. And for the last 12 years, we have been investing in the mobility theme with a very broad belief that mobility touches a lot of aspects beyond just automotive as well. 12 years ago, when we got started, we had this belief that automotive, transportation, logistics, energy, retail, telecom, pretty much every large industry of consequence was really going to undergo quite a bit of change. And at that time, we were looking at smartphone adoption having clear escape velocity, cloud computing really accelerating, and digital payments becoming much more mainstream. And understood that the next couple of decades would reshape these industries. And our viewpoint was to partner with the best founders out there to really paint in the details. And so over that history, we've raised about $300 million of capital, and we've invested in themes like personal mobility marketplaces, connected fleets, automotive technology, autonomous technologies, to also include additive manufacturing and enabling technologies like cybersecurity and others. We're generally seed to Series B investors. It's really where we spend most of our time and capital, but we do opportunistically invest in a few growth stage opportunities that may arise and fit really well with our relationships and network. And over our firm's lifespan, I think we've been really fortunate to be a part of, some tremendous companies, and have seen 18 exits really across a whole variety of different paths, everything from IPOs and SPACs to M&As and secondaries. So I'll just close kind of my opening introduction, with a simple statement that I've never been more excited about this theme. I've never been more excited to be, deploying capital in this market. Obviously, the last 12 months were certainly not what we anticipated, and it's been an interesting ride, but I think the future is certainly bright. I'll turn it over to perhaps Tony, if you want to go next.
Sure, thanks, Chris. So, hello, everyone. I'm Tony Cannestra, the Director of Corporate Ventures at Denso. Denso is one of the world's largest auto parts suppliers. We operate globally, headquartered in Japan, North American headquarters outside Detroit in a town called Southfield. I run the CVC group, and I've been doing it for just about 9 years now, portfolio of 18 companies. Currently, we also do a little bit of acquisitions of startup companies through my group. Mostly early stage, similar to Fontanella, so seed to Series B is our sweet spot. We don't invest for financial return, so for us, it's all around strategic value, identifying startups that we think have unique technology that can provide benefits both to Denso and to the industry overall. And as you can imagine, being a tier one auto parts supplier, we're mostly interested in automotive industry, extension of that into transportation. Things like autonomous driving, cybersecurity, connected vehicle, electrification are all areas that are keenly interesting to us, and other areas that are of core value to us as a corporation. Chris mentioned additive, so that's certainly an area. Advanced manufacturing is always an area of interest to us. Advanced materials, robotics, those are 3 other areas that we tend to focus on as well with our investments. So I'll turn it over to Jason.
Great, thanks, Tony. And thanks again, Howard, Nick, and team for inviting us to the panel. I'm Jason Wortendyke. I wear 2 hats at Credit Suisse. One is I run our Chicago office and Midwest group here. And then globally, I look after a business we call Mobility and Services, which we started about a year and a half ago now, really in recognition there was a large amount of convergence between our clients across capital goods, automotive, and then the business services and technology that support those sectors. So within my team, we do everything from looking at the traditional automotive players to raising capital and acting as advisor for mergers and acquisitions across a panoply of new entrants into the market. And anxious to be here to talk about some of those trends today and reflect on the outlook for the future funding of the sector. Thanks, Andrew.
Great, thanks everyone. So to kick it off, I think we can start with setting the stage and talking about what we're seeing in the market. And I think everybody knows that it's just been an incredibly exciting time for everything auto and mobility related, with the burgeoning SPAC market that is unavoidable and everyone is very well aware of. I think it's created a lot of opportunities, and I think we've seen things trickle down to earlier stage companies and private companies now that has become a viable end game for lots of companies. And so, Jason, I'd like to ask you, what are you seeing in the market in terms of M&A, cap markets, SPAC activity? And then from there, I think we can see what Chris and others think about how that's trickling down to the investments that they're looking at and seeing.
Sure, thanks, Andrew. So look, it's been a crazy year. I don't think when we closed our offices March 13th of 2020, anyone thought that business A would be in such a different mode, and B, it would have gone on this long, and finally C, that we would be having such a great opportunity in these markets to help fund companies, even companies in the higher risk side of the spectrum. And that was really brought about after the initial pall of COVID, and we got into the summer and people realized we were going to be working from home for a while. There were a number of trends in the market that I think personally reached a tipping point. We had a lot of conversations in 2018, 2019 about funding new business models for auto, whether those were OEM models, an electric vehicle or autonomous vehicle, whether they were components and technology suppliers like lidar plays, battery plays, where there simply wasn't a lot of capital. We would go to folks like Chris and Tony, and they would have interest in participating very early. They'd dig deep on the technology. But when we got to bigger capital raises, there wasn't a lot of home for this capital. People wanted to see vehicles in production. They wanted to see, what the monthly reporting was for these new orders, and that just wasn't where a lot of the industry was. And I think with the success of Tesla stock and the idea that there were a lot of new businesses coming to the fore, and frankly, pretty massive government support outside of the US in particular in 2020, we really hit a tipping point. And as a result of that, people started to say, this is when, not if. I'm not making a bet as to whether or not there will be massive EV or AV penetration, but rather I'm making a bet whether it's going to be in 24, 25, 2030. And that was a big change from my perspective from 2019 and 2018. And what that enabled was first a rash of IPOs. We were lucky to be involved in a good amount of those, including a number of the China startups listing in the US, tremendous capital raisings by Tesla and others who were already established in the industry, and a number of large capital formations in the private market. We then saw the advent of SPACs for disruptive technologies. The first real disruptive SPAC that was done was with Virgin Galactic, which to my knowledge was the first sort of pre-revenue, pre-profit company that had gone public via the SPAC merger. And that now has become a pretty tried and true template. We've at our shop done 10 new mobility de-SPACs in the last year. To allow companies that probably otherwise would have stayed private for longer to really pull back their business plan and pull forward their business plan by 3 to 5 years by generating that large capital. And I think that that's a trend which has been very dynamic. And through the first part of this year, you saw just a wave of SPACs, both in new mobility and outside of new mobility, get done. The markets have been a bit choppy since the sector rotation we've seen earlier this month out of technology and high growth into some of the value plays, with people getting nervous about inflation and macro. But if you look across the EV, electric vehicle, and AV autonomous de-SPACs, every one of those SPACs has returned positive capital to investors, even with the 30% or so fall off in some of these markets. And so this we see is still a very durable theme. And while there is some M&A talk, we still think the public equity markets are where the focus is right now of a lot of folks in disruptive mobility. And then the final point I make, and sorry to drone on so long, is the massive allocations we're seeing to ESG and sustainability funds. That's really driven this too. And that, coupled with the US finally getting on the bandwagon of other countries and really doing direct support of electrification and future mobility, we think this is actually quite a durable trend. And we'll see how Tony and Chris think about it, but I do think a lot of their companies will be ready for the public markets sooner rather than later.
Great. That's incredibly helpful. So, knowing that the banner year that it's been for SPACs and IPOs, I mean, I can tell you anecdotally, given the choppiness in the market, I agree, Jason. Auto has continued to do well, and I can tell you that I'm working with a number of companies that are still exploring SPACs and have not slowed down, and the interest has not slowed down. Whereas in other industries, I have seen it slow down. Slow down is a general, that's a relative term when we're talking about SPACs. I think it's still super active and fast paced, but auto seems to be weathering that pretty well. So Chris, maybe over to you to hear, when you're investing in companies, like you say, at the earlier stages where you spend most of your time, how does this dynamic change your thesis and change what you're seeing in the market right now?
Yeah, absolutely. And, not to harp on 2020 too much, but it definitely was the year of 2 years. The first half of the year was very much doom and gloom. Every company in every industry had to adapt to a new environment. And I can tell you a lot of these industries and companies, their downside plans never contemplated scenarios where revenue goes to zero and their workers can't safely work next to each other. And so what we sort of saw across the theme that we invest in is particularly those that were working with parties inside the automotive industry was those customers or partners of theirs maybe had 20 or 30 kind of key innovation projects that were front and center priorities of the organization. And The industry is not new to cyclicality or liquidity crises. It certainly endured many of those over the decades. But last year was definitely a bit of a shock, and we saw across a variety of different parties in the industry that those priorities very quickly shrunk to maybe the 3 or 4 that would be the most impactful in 2020. And fast forward towards the back end of the year, I think as everyone realized they would eventually make it through this, the activity started to flow again. We saw that manifest itself in our pipeline of activity. In the second quarter last year, I think we saw a 30 or 40% reduction. Makes sense. Good companies, realized the water wasn't warm and decided to delay those fundraisers till later in the year. And then as the market rebounded, clearly that activity reemerged to the surface. I think it's been interesting to really watch the developments across the whole SPAC space recently. I think pulling forward capital markets opportunities is definitely the case. I don't think many of these companies quite had 2020 and 2021 as their base case path to a public listing, but it has very much emerged as a front and center topic for really any company that's got a clear and exciting narrative, and also a few exciting proof points to generally point to. I can tell you it's the dominant conversation of companies at all stages. What used to be a pre-IPO round is now a pre-SPAC round. And those pre-SPAC rounds, sometimes they're as early as seed stages in some cases. We'll talk to companies that are maybe not even to the double digits yet of team size, and have already kind of created a plan as to how they expect to be able to access the markets at some point. And so, it's a positive in many ways. It's an addition of scale up capital to many of these companies that really will need it. And it was a great opportunity to remove the financing risk associated with venture as a kind of milestone based financing model. But it can also be a little bit distracting at times, for some of the companies we talk to and some of the companies in our portfolio too, that, maybe get caught, their attention gets caught by a flashy light over there.
Yep, it's definitely a new shiny thing that everyone is looking at and thinking about. It's a great point. I mean, I see this a lot when I'm sitting in boardrooms for my clients. And there is a bit of a tension there, is these companies tend to be very much thinking about these things way earlier in their life cycle. And the question often comes up, is this where you want to spend your time? It's a shorter amount of time than a traditional IPO. You're looking at potentially a few months to get through SPAC, but it's still a significant undertaking. Your management team is going to be highly focused on it. You're going to have to shift resources away. So it's a good thing to think about. Tony, interested to hear your perspective, the CVC perspective. So I suspect that you're not always looking to acquire, and I think CVCs just generally like to see their companies thrive and be self-sufficient and self-sustaining. Is that how you're thinking about it, or has this changed your view in how you look at companies and what outcomes you're gearing towards?
It changes our view much, Andrew. I think what has been interesting, which Jason and Chris already alluded to, was the ability to pull in fairly large amounts of money. And we like to say SPAC, but really the benefit here is the pipes that go along with the SPAC, because you're preemptively raising large amounts of money that you don't now have to spend 2 or 3 rounds of doing. Right, because if you, as you mentioned already in the opening statement, it's a slog in automotive, and especially if you're in hardware. I mean, when we invest in a Series A company, I tell the CEO, get ready for 7 years, 8 years before you get designed in and hopefully get into one model year that makes it out into the market. And so getting to large volumes will take 10 years ish to get there. And so a lot of these companies, successfully going through a SPAC and getting the pipes done are essentially, not having to deal with Series D, Series E, Series F raises. And going through that work, I think, or not having to go through that work is a huge benefit. That's one of certainly the pros of doing a SPAC. Now, are a lot of them ready in terms of how their organization is structured, and do they have the right skill sets, and are they ready to do public reporting? Most of them are not. And so there's going to be some stumbles along the way in that regard. And I think that's some of the cons that they have to consider at the board level. But it's hard to turn down that amount of money and be able to free up the management team to really go aggressively after their target market. I think one of the other aspects of it, maybe there's too much money right now in SPACs, in that I'm not sure the market really needs 7 public lidar companies. And I'm not sure that those discussions are being held enough at the board levels, especially for the last 3 or 4, right? But that's, the market will sort that out, and that's the market mechanism that we get to work with now that they are public. So there's definitely pros on some sides of being able to raise a lot of money early, get it done. Certainly we worry about doing early stage deals and then thinking about who is next in terms of taking up the mantle of raising money for our startups. And now SPACs have become a reasonable alternative in that discussion. Whereas before, we may not be willing to fund a company all the way through DEF. Most of our interest is in the getting the product and the technology developed so it's ready for the market. And you may get to that stage and then find yourself stuck a little bit in fundraising, especially in the automotive area. So the SPACs have certainly been a benefit in that regard.
Yeah, that's super helpful. So I think we've touched on a bunch of pros and cons of SPACs. You've got the cons of shifting attention from execution and potential distraction. The benefits being getting that capital up front and being able to avoid the multiple rounds that you may need to get farther along. So any other thoughts on the pros and cons of SPACs here that we may have overlooked? Jason or
sorry. Yeah, the one thing I'd add, Andrew, is and it was touched on, but just to say it more directly and explicitly, a lot of folks who are in the stage where they're talking more to Chris and Tony than to me about an IPO, and then they see an ability to accelerate what is really a hyper growth business that probably still needs a lot of time and attention from the founders, haven't really thought through what it means to be a public company CEO or CFO. Tony mentioned, there's time, but it's also just capability, right? It's a different skill set than when you're in a startup. And so we are seeing a lot of transition. Now, SPACs can be helpful with that because sometimes they can bring some seasoned board members, drop in a experienced public company CFO that they might have on their staff. So that's helpful, but it is a big change in your corporate life cycle. And we'll see how over the long term, some of these companies deal with that too, because it's not just about the technology risk of lidar, to use the example Tony did, but also the execution risk of being a public company management team. And then I do think what we're going to see out of this period of market volatility is a flight to quality. I think there has been a bit of overheating in the market for sure. But I think that this fundamental theme of electrification, autonomy, just the whole future of new mobility, I don't see that on a macro basis slowing down. So whether it's SPACs or IPOs or, bigger, pre-IPO venture funds, I think there's still going to be a lot of capital out there for this theme and this trend in particular.
Yeah, that's a great point. And Jason, just to touch on that a little more, are you seeing more consolidation, kind of following along with what Tony said, is do we really need 7 public lidar companies? And we have seen a lot of consolidation already. Do you think there's going to be more of that? Are you seeing it now, or?
Yeah, we're seeing the very early stages of it. I think what Tony meant is we really need 12 public lidar companies because there's a few more coming. But if he did mean less, which I think he actually did, there will be consolidation. And we've in fact been involved in some early stage companies who said, if I did have all this money, sure, I have my funding need for my technology, my rollout, my distribution plan, my manufacturing plan. But if I had an extra X, whatever tens or hundreds of millions that is, I would actually buy this little competitor over here because it would really complete my picture. We saw that in the first early days of some of the startup SPACs, with the DraftKings deal, which was a merger through a SPAC, not just with the SPAC, but also between 2 companies. And you've seen that in a couple other areas. So SPACs can enable in that way too. But I think straight M&A will also fall out of this, right? There will be winners and losers out of whether it's the lidar bunch or the battery bunch, or even the OEMs and the passenger and commercial vehicles. But a lot of these companies have a really good aspect, whether it's technology or brand or customer relationships, and perhaps there needs to be some consolidation, just as there have been in many industries over time. So I think the massive capital formation here follow a couple of years of that. I think we will see then which businesses really were ready for prime time, or which maybe have a nice piece of technology or a nice piece of business, but really should be a part of a different or merged entity. So I do think it'll be a driver of that as we look out, probably not in the next 12 months, but in the next 24 to 36 months.
Yeah,
Yeah,
absolutely.
Andrew, I think Jason made a great point too about the consolidation aspect of all of this. In some ways, the SPACs are stepping in and doing a degree of consolidation we all saw coming at some point. Not to belabor the point around sort of the lidar market, but whether it's 7 in the public markets or it's 60 in the private markets, I think everybody recognized that there would be a point of consolidation at some point, and it would likely be capital that would be one of the aspects that force that consolidation. And I think what we're seeing here is a potential acceleration of that. A degree of kind of king making, if you will, in the industry by properly capitalizing companies to sort of accomplish their roadmaps appropriately. And it will be interesting across all the various themes of which companies decide to stay in the private markets longer, and whether that ends up becoming a competitive advantage because they can stay out of the limelight, the investor limelight, a little bit while they focus on execution, versus those that maybe have the resources of putting together a $300 or $400 million SPAC and another $300 or $400 million pipe, and sort of not have to be in the market repetitively raising capital, although maybe having a very different set of expectations to achieve against.
Yep.
Yeah, that's a great point. I mean, it is kind of turning things on their head. Whereas, right before this boom, we were seeing companies staying private longer, raising tons of capital. You had the Rivians and the Auroras out there who got to raise tons of money in the private markets and continue their development unimpeded by these public company requirements and needs. So, given the advent of the SPAC, how do you think about SPACs versus IPOs, the traditional IPO, going forward? Do you think it makes a traditional IPO more or less appealing? Do you see benefits of maybe the marketing value and that type of thing?
Yeah,
What's the view
I think
there?
look, there still is very much a role for traditional IPO. I mean, the SPAC has a few features which are negative versus a traditional IPO. One is the fact that there is a cost associated with it. Now, if you're in a disruptive technology company with a very large market cap and a relatively small cash need versus that valuation, then the cost of the SPAC is comparable or actually less than an IPO. But if you're, a smaller company that's trying to go up and raise a phenomenal amount of capital, the dilution could be greater under a SPAC scenario. And so you have to think about the economics of it. That said, the pros of sort of timing, speed to market, and a SPAC sponsor is bringing something more to the table than just financial capital like you would get in an IPO are real benefits. I think there is, though, a very strong future for IPOs. There will always be businesses that don't want to be tied to someone else, right? You have a SPAC partner that's going to be in your stock for a year at least, probably more. You're going to have board members come on that aren't, a part of your original plan, perhaps. And so there are, people that are going to say, no, I don't want that, right? I want to take my company public in the old-fashioned way. There's also been a number of developments in the IPO market, which, are very, I think, polarizing. We in investment banks think that we know how to do the IPO business pretty well. There's, direct listings and other technology now that are trying to disintermediate a bit the tried and true process of book building. And for good reason. There's reasons to try these other aspects to access the capital markets. But I do think the marketing, the research report, some of these things really are good for companies and distributing them to the right holders initially, versus the SPAC process, which has at times some unnatural holders of the shares being stuck in there for longer, can be a big benefit. But you have to be a company that's of a certain scale. It's very hard to get the sort of amount of capital and funding for a pre-revenue or a very early stage company through a traditional IPO.
Yeah, great point. So, with all of these, I think we touched on this, but not as directly. So with all of these great opportunities for exit. How are you seeing this impact the early stage financings in terms of valuation? And this question is primarily to Chris and Tony. How do you think about these new valuations that we're seeing tick up? How do you think about that?
Yeah, maybe I can go first on that one. I mean, we're definitely seeing it playing out across really all stages. Part of that is just people's belief about what the size of the exit outcome is has gotten bigger. So their expectations in those first financings have certainly gone up. I think what we've seen too is just the way deals are getting done today versus pre-COVID have changed. I can't recall if it was Yvonne in the early sessions from Bosch that said too that removing some of the barriers from a speed standpoint to getting those first meetings and first conversations has certainly accelerated some of these processes. We were sharing internally a note yesterday from one of the other storied venture firms out there that over the last 15 years, they've seen their timeline from first meeting to term sheet go from 90 days to 9 days. And so I think there is a lot of capital, and there's just been a lot of compressed processes, a lot of competitiveness for really good early stage opportunities. And I think some investors with a viewpoint that if maybe they won't be able to get their typical X million dollars in over multiple rounds, they might be more compressed to do so in the earlier stage rounds more quickly. And so, that's all had a price implication to it. Valuations have certainly, stretched upwards over the last 6 months, particularly in anything related to electric vehicles, largely driven by the fact now we go from having one big public comp, in the market that everyone was focused on to now a whole variety of these EV SPACs that have recently gone off.
Yeah, that's helpful. Tony, how do you think about these things from the CVC perspective? I think generally CVCs are a little less price sensitive, but interested to hear your take on that.
Yeah, I think I certainly agree with Chris. And I mean, what we've seen over the past 6 to 8 months is let's call it a frothiness, or as Mr. Greenspan would have said, maybe a bit of irrational exuberance. About valuations of early stage, pointing at what they view as reasonable comps, either in the SPAC market or in the EV market. We're not as price sensitive as our financial VC brethren because we're not, again, focused on the financial return out of it. But at the same time, we do realize that through our own experiences in the industry, timelines never pull forward. So any given seed stage startup, start a Series A startup, even Series B, they're handing you a financial projection based on a timeline of when their technology is going to be adopted. It almost never goes that way. I mean, 99% of the time you see delay in adoption and deployment in the auto industry. You don't see things pulled forward. I would think maybe the only exception to that that we'll see in the near future will be cybersecurity, where there's going to be, I think, a big rush to get more cybersecurity solutions into automobiles. Certainly, the EV market has pushed up valuations. You see a lot of entrepreneurs at the early stage wanting to be able to grasp those higher valuations. I push back a little bit on it simply because I'm worried about what is the future of getting out over your skis, so to speak, on valuation, right? And if there's a hiccup in the market 2-3 years from now, you're really going to get hammered if you've driven up your valuation in the A round, the B round. My caution to them is just you don't want to go through that pain if you can avoid it. So let's keep things a little realistic and understand that what you're showing me might be attainable, but more than likely is going to be delayed by a year or two, best case.
Yeah, I think that's a great point. I mean, getting out over your skis is a great analogy. I mean, the SPACs are certainly exciting, and frothiness is a good word for it, probably. But again, I think this could change. We've seen turbulence in the SPAC market recently. There could be regulatory shifts. There could be, the SEC could do something about including forecasts and for SPACs, and it's definitely an important consideration. And I think it's easy for early stage companies to lose sight of when they see that bright light in the near future.
On the issue of timeline, by the way, I just an anecdote to throw in the mix. When Joby Aviation made their presentation at this workshop 5 or 6 years ago, I decided not to invest because number one, the timeline would be too long. It was a long shot. The amount of capital would be required would be huge, and dilution, of course, would be considerable. And SPACs did not exist, so at least they weren't popular. So, who would know that, it probably would have been a good investment. So timelines have changed. And I wonder if you think about that. I mean, presumably they've been compacted. And so there is a possibility that even something that looks like it's going to take a long time, you could have a good exit just because of the financing environment, at least today in this window. Now, maybe the window is going to close. I mean, who knows? And the other dynamic I've observed, of course, is that there's just, there's this 7 lidar company phenomenon. If your competitor lidar company has gotten a SPAC done and you don't have the cash hoard to compete with them, then you may be stuck, right? So presumably there's a pressure for everybody who's.
Yeah, I think you're right, Howard. There's a couple different things you have to unwrap there, though, right? When you talk about timelines, there's a difference between timeline to get your technology developed and deployed into market versus the timeline to achieve a financial return.
Yeah.
So the timelines to achieve a financial return have greatly accelerated thanks to SPACs.
Right.
And on the second point, I completely agree with you. If I went out and I saw Velodyne and Luminar go out and get their SPACs done, and I'm AI or Ava or Ouster, I'm looking at it going, man, I've got to compete against these guys now, and they've got a couple $100 million of pipe money in the bank, and they're public, gives them an opportunity to raise even more money in the public market. I've got to get out there and compete against them on that same financial footing. So you're right. I understand why there's a rush to get those SPACs done, and hopefully they'll all have a chance to survive and thrive. But I would tend to agree with Jason that there will be consolidation a year or two out that will dramatically decrease, but in some ways decrease the number of players.
We've got about 1 minute left. Do we have other questions or other comments?
Final words, anyone?
Final words of wisdom, just wisdom though, not just words. Well, there's been a lot of wisdom already spoken here on this panel. It's been really good. Excellent panel. I'm glad that we had people from diverse walks of business and life on this panel, because we got a lot of different perspectives. Thank you all.
Howard, the final words of wisdom I would always impart to everybody is harking back to SPAC, right? Live long and prosper.
Okay, excellent. Andrew, thank you for moderating this excellent panel, and Chris and Jason and Tony as well for speaking.
Thank you, guys.
Thank you.
Of course.
Thank you all.
Good luck,
Thanks, Howard. Bye-bye.
Right.